Good morning, Bitcoiners. Welcome back to your economic calendar, the information you need for the week ahead in Bitcoin. As always, I'm Mauricio here at Ledn, and today is Wednesday, February 22nd. And in this week's issue, we're looking at three drivers that are impacting Bitcoin markets. Number one is the Coinbase earnings report. They reported results yesterday or last night, and they reported a higher than expected revenue and a smaller than expected loss. We look at what this could mean for the stock and whether it could spill into Bitcoin markets as well. Number two, we're going to look at the US dollar, where recent moves in the bond markets suggest that the US dollar could be setting up for its next move, and we look at what that could mean for markets. And number three, we are looking at China, where recent moves by the Chinese central bank have injected new cash into the economy, and that has re-sparked economic activity and is spilling over into the global economy. So, without further ado, let's get into today's show. Now, as always, let's take a quick peek at Bitcoin's performance last week before we get into today's analysis. As we can see here, last week, Bitcoin snapped its 2-week losing streak, rising by more than 11% and closing at 24,281. Now, interestingly, if we look at the daily chart here, this 200-week moving average level that we had been tracking at 24,915 seems to indeed be acting as resistance to the upside. As you can see here, we've been trying this for 1, 2, 3, 4, 5 days now, and it has now rejected that level. So far this week, it has been selling off along with the rest of the markets. We'll get into that in a second. Of course, this level, as we can see, has become quite important, and it will be the next key level to clear in order to continue the rally to the upside. Interestingly, we are still not seeing any significant buildup in Bitcoin short positions, and this is what we are referring to right now. As you can see, Bitcoin short positions on Bitfinex still remain near historic lows, even after last week's 11% rally. This is healthy and consistent with the shape of the current Bitcoin futures curve, which shows a pretty healthy contango, meaning prices moving progressively higher further into the future. Now, going back to markets in general, we see that markets did open in the red this week, with focus shifting back to US interest rates and stickier than expected inflation. Importantly, the Fed meeting minutes that will be released this week will be very relevant to markets, as they could provide clues on how the Fed is thinking about its next rate hike in March. We do cover the details of when that will be released in our What's Ahead section later today. Now, in terms of technical support to the downside, if this down move is to continue, we are looking, or we're still watching, this 200-day moving average level as a potential key support, and that is sitting right around 19,700, very close to the very important 20,000 level for Bitcoin. And let's get into topic number one of this week's issue, which is the Coinbase earnings report. So as you can see on your screen, last night, Coinbase reported higher than expected revenue at $629 million versus analyst estimates of $590 million. And it also posted a smaller than expected loss at $557 million loss for the quarter. Now, at the same time, the company posted 8.22 million monthly transacting users, which is down from the 8.5 million monthly transacting users they had in the previous quarter. And trading volume also fell by 9% from the previous quarter to $145 billion in trade volume. The stock has, since the announcement, been reacting positively, and at the currently it's actually bouncing around. Let's take a look at Coinbase price action for now, and you can see that it is basically bouncing up and down from the levels at which it closed yesterday. However, one potential reason that the stock may be moving higher is that many investors were short the stock going into the report. And as we can see here, this is short interest data for the Coinbase stock as per Benzinga, as you can see on your website. And according to the data from this website and others, the over 23% of the available trading float of Coinbase is currently being held short, which means or represents approximately 2.1 full days of trading volume to the buy side to cover their open short positions. Now, with earnings results coming in stronger than many expected, this setup could potentially trigger a short covering rally in the stock in the days ahead. And we will be closely monitoring this to see if this does spill over into Bitcoin or crypto markets more broadly. Now, the second point we want to talk about in this week's issue is the US dollar. And the big question that is being set up by the chart on your screen is, will King Dollar rise again? And let's get into what we mean here. Since the start of February, US bond yields have been rising. This is this orange line here that you can see. And as you can see, this is February 1st. This is the exact moment in which this orange line starts basically going pretty much vertical at this point. Because of these rising US bond yields, the US dollar has also been strengthening, and most asset prices have suffered during this time. As you can see, there's a pretty clear line as when the orange line starts rising and when the dollar chart, which is this green and red line, starts rising as well. So as you can see, as the bond yields rise, the US dollar starts rising. Now, as we've covered before, as the real rate of return of the US dollar rises, or US government bonds moves higher, this typically strengthens the US dollar as more people demand the US dollar, which has now an improved risk-free return on holding the set dollar. Therefore, there is a very tight correlation between US government bond yields in general and the US dollar index. As you can see from the chart, the correlation between the US dollar index, which is this green and red line, and the yield on the 10-year bond, which is the orange line, is quite tight. As you can see, these two lines cross each other often and tend to move in tandem. Now, currently, as you can see from the big gap between the orange line and the US dollar index line, there is a significant deviation from this correlation, as we can see here. And we saw a similar gap or delta earlier in April of this year. Now, what this means is that either the yield on the 10-year Treasury bond is too high or the US dollar index is too low, or a combination of these two things. Now, on the interest rates side, the Federal Reserve has been very clear that it wants to keep rates high until the job is done. And recent inflation data shows that inflation could be stickier than many expected. This now suggests that it is not the yield on the 10-year note that has the catching up to do. Now, a renewed US dollar rally could put pressure on asset prices in the near term. And other macroeconomic factors that could act as a tailwind to a potential US dollar rally are an intensification of the conflict in Ukraine, as well as China pumping fresh cash into their economy. And we're going to get into that in a second. Now, the third topic we want to discuss in today's issue is China and how it is pumping cash into its economy. Now, as we have covered here previously, China suffered the economic consequences of its zero COVID policy last year. It caused chaos on supply chains all over the world and the local Chinese economy. Now, it also led to lending crises like the Evergrande saga that threatened to spill into their local real estate market. We were covering this at length towards the second half of December, or the first half of December rather, of last year. But the Chinese government started intervening earlier this year to jumpstart its economy by easing monetary policy. And those efforts seem to have accelerated recently, with the Chinese central bank ramping up cash injections into its banking system. And as you can see from the chart on your screen, last week, the Chinese central bank conducted $39.3 billion worth of 7-day reverse repo facilities at a rate of 2%. In English, or in plain English, the Chinese central bank is injecting cash into its economy at a rate of 2%, which is pretty attractive if we compare it to the Fed at north of 4% in other parts of the world. Now, their aggressive action is starting to pay dividends. Last month, new bank originations, loan originations in China jumped by more than expected to a new record of $713 billion in the month of January. This narrative of money pumping into China has also led to a series of rallies in China-related speculative crypto assets, as is Conflux, from what you can see on your screen. This seems to be a public blockchain token that trades in China, and it has been rising quite dramatically, as you can see, over the last few days. Now, to cap this all off, yesterday, Hong Kong proposed new rules that would allow retail investors to trade certain large cap tokens in licensed exchanges. Keep in mind that this is not mainland China. This is Hong Kong. And in mainland China, mining, Bitcoin mining in particular, was banned last year. Now, however, there are no accidents in politics. This action is very deliberate. To some, it could be seen as an escape valve to allow investors an outlet to trade into crypto in a licensed manner. It could also be a test case before rolling out a similar policy in mainland China. Nonetheless, this has brought in a lot of excitement into crypto markets in general. We'll continue to monitor this narrative and this development. And as always, we wrap up with what is ahead for the rest of the week. The remainder of the week is loaded with economic data and earnings that could move markets. Later today, we're going to get the minutes from the Fed's last meeting and earnings from eBay, Nvidia, and others. Tomorrow, we'll get a read at European inflation, a Fed speech, and earnings from Block, which is the parent company of Cash App, Mercado Libre, and more companies that could impact Bitcoin. The next Bitcoin mining difficulty adjustment should happen at some point on Thursday and should bring difficulty up to another record high north of 40 terahash. And on Friday, we'll get another read at US inflation with the Personal Consumption Expenditures Index and an important speech from the incoming governor of the Central Bank of Japan. Now, as always, you can look at the entire list of details of when this economic data is coming out in our blog or email. You can also see it in the chart that is on your screen, which you can find at our social media handle at Hodl with Ledn. We posted this last Monday. And with that, we have reached the end of today's show. If you enjoyed today's show, if you learned something, I welcome you to like it, share it with your friends, subscribe to our channel. If you don't yet have a Ledn account, I welcome you to check us out at ledn.io and learn how you can start earning the best interest rates in your USDC and Bitcoin. And you can also access the world's best Bitcoin-backed loans. You can check them out. We also have the Bitcoin mortgage and our B2X loan product for those of you that want to use your Bitcoin to buy more. And with that, thank you so much. Los quiero mucho and see you next week.